Hello, everyone. Today on the Final Bar, it's Thursday, December 8th. We're talking with Frank Cappelleri of CappThesis. We'll get his take on the overall market environment. Kind of a choppy day, to be honest with you. The Dow, the S&P finishing in the green, along with the NASDAQ leading the way. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The technical analysis toolkit, which we feature on StockCharts.com, is designed to help you navigate uncharted waters, pun intended, uncertain times, and try to make sense of things when the market seems challenging. I've had a lot of conversations here in recent weeks with different media outlets, certainly with our viewers, about what to expect and the balance between the seasonality, where we tend to be in a seasonally stronger part of the year, certainly in November, which we saw, but very much the case usually in December. The seasonal weakness you tend to see in the new year, particularly the month of January, which doesn't tend to be particularly good. And combine that with the fact that we've had quite a bit of a change of character in these markets over the last 4 to 6 weeks. And a lot of those reversals have arguably potentially run their course, right? You saw stocks rally off the October lows, potentially exhaust at the 200-day moving average for the S&P, now rolling lower through the course of this week. A lot of question marks. We'll try to answer those questions, or at least give you the tools that you can use to answer those questions better through the course of this show and elsewhere on Stock Charts TV. Great guest today with Frank Cappelleri. I'm excited to talk to him and look at some of his charts together. Wanted to let you know about a special guest we have on Monday. On Monday the 12th, we have Jeff Hirsch. Jeff's the editor of the Stock Traders Almanac. His father, Yale Hirsch, actually launched the Stock Traders Almanac many years ago. Jeff's going to come on the show talking about some of the seasonal tendencies in the end of the year going into January. He'll feature some of the charts that he will be including in next year's edition of the Stock Traders Almanac. That's on Monday the 12th. Tuesday the 13th, Sean McLaughlin of All Star Charts. Wednesday the 14th, Sam Burns of Mill Street Research in Boston. Also wanted to let you know about my next webcast with Market Misbehavior. That's coming up next Tuesday, December 13th, 1 o'clock p.m. Eastern, called 5 Best Practices for Stops. I have gotten asked a lot in 2022 about risk management, about setting stops, particularly when we're rallying off the October lows. Where should I be thinking about stops? How should I be managing downside risk, which I would argue is very real going into the first quarter? We'll talk through some of the things I've picked up through my career. Go to marketmisbehavior.com/stops to sign up for that free event coming up next Tuesday. Let's continue on our show today with the market recap. Let's talk about what we saw, what we learned using the best practices of the technical toolkit. The S&P 500 up about 0.75%, just under 0.8%. The NASDAQ composite leading the way higher, up over 1%. The technology sector, in a rare move, actually leading the markets higher. Tech was up 1.6%, the XLK. We'll get to the sectors here in a few moments, but a nice bit of a mean reversion from what we've seen in recent weeks and in recent days. The VIX pulling back a little bit, now well above 20. And one of the, I think what could be in the future, we might look back and see the VIX getting just below 20 and now reversing very quickly to the upside. That might be yet another really good sell signal. That's happened 3 other times, I think, in 2022. And overall, it's been a pretty good indicator of the end of a bear market rally phase. Will this time be different? We'll let the charts tell us, but overall, it's meaningful to me that the VIX is now pushed back above 20 after dipping below there. That's been a pretty good indication of a reversal of sorts here so far this year. Interest rates, which were moving lower in a big way yesterday. 10-year yields almost got down to 340 yesterday, pushing back to the upside today, testing around 350 and finishing the day just below that. The dollar index coming off of it, the UUP, which is a bullish dollar ETF, was down about 1/3%. And one of the reasons, or maybe one of the great, I guess, ways of reflecting on how the markets have evolved, sort of the different narratives at play in 2022. The strong dollar has certainly been one of the key ones. I would put that with the Fed and inflation and interest rates. The dollar obviously sort of all wrapped up in everything that I just mentioned. But if you look at the trend in the dollar index through the course of 2022, dramatically higher, while most risk assets were dramatically lower over that period. Last month or two, we've seen that trend reverse, and we've seen the dollar pull back to its own 200-day moving average, just as the S&P is testing its 200-day moving average from below. Do we get a bit of a stronger dollar again? Do we get a reversion back to that trend? That was the case for most of 2022. If so, and that's why I think it's such an important chart. If so, it's hard to imagine that the equity markets can improve dramatically from current levels if you would get the dollar sort of resume the uptrend that has been, again, the story for most of the year. Gold, a little change from yesterday. Silver prices were up a bit with the SLV up about 1.4%. Kind of mixed bag overall with oil in the red, which is notable. The energy sector struggling a bit today. Nice sort of move higher in cryptocurrencies. A lot of this happened earlier in the day as the equity trading day evolved. It kind of pulled back a little bit, but Bitcoin has pushed above 17,000. Ether not quite above 1,300, but got just to 1,290. Again, the challenge with those charts is, to be honest with you, they're going down. And that's not a recent phenomenon. That is not just because of the FTX debacle or anything like that. This has been a trend through the course of 2022. And my question on any of those charts is, do you regain resistance and do you hold it? So getting above some of these levels that we've talked about previously and holding those gains would be important. Not yet would be my answer, thinking about the chart of Bitcoin in terms of upside momentum. Let's check in on a chart of the S&P 500. We'll look at some other charts as well to sort of round out this market recap. When I'm thinking about the big picture in the S&P, this trend, I feel like as time goes on, I'm going to end up making this trend line more and more bold-faced, right? So I have like level 2 of 5 using the StockCharts annotations. I might kick it up to a 3. It becomes more and more important, right? When something's a more important line, I tend to make it a little thicker just so it catches my eye. I tend to make it a more obvious color. So I don't have to say anything. If you see this line get thicker, if you see the green turn into like a dramatic color, like a bright pink, that might tell you to be more concerned about this level of resistance. But it's certainly been a great representation of the pace of this downtrend, right? It's connecting the January high, the March high, the August high, and that lines up almost perfectly with last week's intraday high around 4,100. We've talked about some of these key levels of resistance, and we talked on the way up out of the October low, particularly when we put in this higher low in November. The question is, where do we go, right? What's the upside potential? We talked about levels like 4,000, which is a key Fibonacci level, which we, of course, eclipsed after pulling back there here in early November. We talked about the 200-day moving average, and we talked about, finally, the last line of defense, this trend line using the 2022 highs. Somewhere along the way, through getting through all of those resistance levels, the market has sputtered out for now. Now, we saw a nice bit of a bounce over the last day or two. This is after a doji candle on the S&P 500 yesterday. So bouncing a bit off of that. Again, I'm inclined to think more downtrend based on the overall weight of the evidence until we start getting above those levels. If we get above the final level of resistance that I've identified, then I can't be anything but more constructive at that point. But I'm going to patiently wait for that sort of move to happen, and I'm not seeing it yet. Now, what's really interesting, and I'm going to talk just briefly about sector movements, then I'm going to show you one of the key charts to think about this market. What led today? Technology up 1.6%. That's the XLK. NVDA was up 6.5%. Decent up move in a stock that's been one of the better, maybe more positive outliers in the sector. The XLY, consumer discretionary, was second, up 1%. Healthcare, very close to that. On the downside, energy, which was down 0.5%, not too bad. But again, after leading for a lot of the time here recently, very much a different feel. Communication services was down about 0.25% as well. Everything else was up on the day. But what I want to show you here to finish off our market recap, if I go to charts and tools, we have this thing right down the right column called sector performance chart. This was a great way of showing the performance of the different sectors. And if you scroll down a little bit, this is Sam Stovall's idealized representation of the market cycle, the stock market cycle, and the economic cycle. And a couple brief observations before the break. First off, note how the equity markets, the stock market, tends to lead the economy. So if you're looking at economic data and using that to try to project what's happening with stocks, you're doing that reversed, right? What you want to do is look at the stock market as a way to anticipate what's changing in the economy, because stocks tend to recover before the economic data starts to improve. And what tends to lead out of those lows are sectors like technology and consumer discretionary. So a day like today, where you see them working, is encouraging. You need to see more of that. And that's what I think we've not seen yet, particularly coming out of the October lows, to the point that I think we could declare a clear bottom and a sustained recovery from here. So let's keep an eye on what has tended to work in previous cycles. Let's take a quick break. When we come back with Frank Cappelleri, we'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. A couple quick comments before we bring on my guest today, Frank Cappelleri. First off, we welcome your questions. We had a great mailbag segment on Tuesday's show. We'll do another one on Friday's show. We love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We are on Twitter, so tag us in a comment at FinalBarSCTV. And we are on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We are so fortunate to have an incredible group of guest experts coming through Stock Charts TV. People like Frank Cappelleri, Tom Boley, Greg Schnell, Larry Williams, Martin Pring, many, many others, all with their comments and their expertise sharing with you for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to continue on today's show, welcoming on our guest, Frank Cappelleri. Frank is the founder and president of CappThesis, recently launched his own service. Frank, it is a pleasure to have you back on the show. How are you?
Dave, thanks so much. And also, thank you very much for your encouraging words over the last few months as we got into this launch.
It's always a fun challenge, and I wish you well, of course, Frank. Talk us through some of these charts that you were going through. This is one that you shared earlier, and I really think it's an interesting way of thinking about this current upswing. Talk us through your chart of the S&P.
Right. Well, Dave, you did a great job looking at this, looking at the downtrend line and also the 200-day moving average that the S&P keeps pulling back from. I like to look at downtrends and explain it in one of two ways. One, we know that when we have a downtrending market, bearish patterns work. We get downside targets hit. Just as important, bullish patterns don't work. So failed breakouts, as we see here. And we have lighted here 4 of the biggest ones. Most recently, one we saw broke out in November. And so, thinking about 2021, it was okay to wait for a pullback because the resolution was typically to the upside. Now, if we wait for a pullback and then buy the breakout, the move is over, right? You're talking about 10, 15, 20% rallies just to get back to a key resistance point, and then it fades at that point. So I think, before we get to the point where we can think that one of these is going to work, we need to see that happen. Now, these are bigger patterns, but even the smaller ones really haven't worked out. We've had some very big upswings. They've been really severe. And sometimes even the smaller patterns get whipsawed a bit.
It's such a great chart. And really, we haven't had that sustained breakout, right? Something that actually follows through and continues to the upside. Your second chart is looking at consecutive days where we have 1% losses in the index, right?
Right. So 2 things about this. One, you don't get a lot of these per year usually. There have been 13 of them happened so far in 2022. But typically when you get a good amount of weakness in a cluster like this, we can go back and do some studies and sometimes point to the fact that it's a good low to rally from. Obviously, it's not the case this year as well, because what really struck me about this chart was that you couldn't really pinpoint a time when this tends to have happened. We see that it's happened after big rallies, like in the early part of April. So the same thing in August, right? And it also comes at the end or in the middle of big downturns like we saw in September. So when you have big declines, Dave, as you know, you usually get big gains as well. And so far, you add them all together for this year, just about 120 moves at least 1%. That is a lot. And typically, those don't happen in a vacuum. So we have to wait for that start to change as well. And typically when it does, you know how it goes. Uptrends, you usually get low volatility, you get smaller moves, smaller volume, complete opposite of what we have right now.
Your third chart is digging into volatility. We're gonna talk to the VIX a little later in today's show. I'm curious what you were seeing in your chart of the VIX here.
Right. So volatility is here to stay because of the 1% moves. And so when people talk about the VIX not moving as well, I think about more of a conundrum. To give you an idea just how strange it is, we've only had 4 times this year so far, with weeks of up 20% or more. And that is a fewest amount since 2017. And Dave, as you know, the equity market in 2017 is completely different in 2022. You probably don't hear too many comparisons between the two. But I would say the big difference is that the level which the VIX is at, right, between 20 and high 30s, where in 2017, it went below 10 numerous times, right? So we have to understand that when you have a VIX still relatively elevated, there still is a risk of this, spiking at some point.
Your final chart is a ticker that I know a lot of people probably aren't familiar with. Can you talk us through this zero coupon ETF and what it tells you about the conditions here?
So a lot of these bond ETFs look the same. I like using this one, zero coupon bond, because it really moves with inflation. So zero coupon bonds in general, high duration. So when interest rates move in either direction, this really has an enhanced move as well, clearly in the opposite direction. And so with the yields coming in, this is just gone bananas, right? Up nearly 30% in 7 weeks. You can see the last time that happened was because of COVID-induced craziness that occurred in 2020. So 2 things. Number one, we know this type of pace is unsustainable. Number 2 is just goes to show that we need some sort of pattern to key off of it to understand if this is going to be an extended move with bonds here, or is it just going to be back and forth and this is going to be the end of it.
It's a series of great charts. We only have about a minute left, Frank, but I'd love to ask you, when you think about next week, we have the Fed meeting. Of course, we're going through the end of the year. December tends to be pretty strong. January tends to be a little weaker than average. When you're looking forward into the new year, do you see this as a time now to be sort of digging in and getting more defensive? Is it time to think more longer term and put offense back on? What are you suggesting to your users?
Well, I think it's very important to identify relative strength when it happens. And it's very easy to say that was energy for a long time, right? And there's obviously been instances of that. But recently, it's been healthcare a lot. So XLV has been close to the highs. And I was looking at some of the names I went through yesterday and within the sector, there were 13 of them within 3% of their highs. And one that really stood out for me was Regeneron, REGN. And you can see that it's percolating near the highs right there. And, as technicians, Dave, we're supposed to not even look what the name is, go through charts, see what's percolating, and go with the flow there. So I would look for names that look like this one going forward.
It's impressive. Regeneron making a new 52-week high today yet again. Frank, listen, it is awesome to see you. Congrats again on CappThesis. Wish you well and happy holidays. We'll talk to you again in the new year, okay?
Thanks so much, Dave. Appreciate it.
That's Frank Cappelleri. Frank's the founder and president of CappThesis, longtime technical analyst at Instinet. I always have enjoyed following Frank and his work. I love his take on just thinking about these different relationships. That first chart about failed breakouts, I think was just absolutely brilliant, right? In a bull market phase, stocks approach resistance and break through. And you can tell it's a bull market. You don't even have to look at a chart of the S&P or the NASDAQ. You can see it because it's reflecting on charts that are able to follow through. In a bear market phase, those breakouts don't follow through. You don't have that influx of buying power, that influx of positive momentum to push things higher. And I think Frank picked up on a key narrative in 2022. And for now, we haven't yet seen that narrative reverse. Great take there from Frank Cappelleri at CappThesis. Let's continue on our show today with our next segment, Getting Sentimental. We like to do on Thursdays, usually check in on the sentiment data. A lot of that weekly data is updated on Wednesday into Thursday, some of the surveys. And so it's a really good time to sort of reflect once a week on what indicators of the sentiment variety are telling us. Now, as a reminder, I tend to think of a macro discipline in three different parts. The number one most important would be price, right? So if I knew nothing else, and that was one of the first things I remember Ralph Ekampora, one of my mentors, ever telling me, he's like, if you know nothing else about any chart, know the S&P 500, a daily chart of the S&P 500. That's your starting point. And that has definitely stuck with me. So price, most important. Second to that, in my opinion, is breadth, which is looking at participation, right? Because a lot of times, particularly at inflection points, the markets, the indexes will do one thing. The stocks that comprise those indexes will often diverge. And I'll never forget the 2007 peak. You had breadth indicators rolling down. You had a lot of growth things rolling down, small caps rolling over, while the indexes are still making new highs going into the second and third quarter. Third piece of that is sentiment. It's still important. It's still something I review regularly, but it sort of, in my opinion, provides a lot of context, provides sort of additional things you should dig into. A lot of times I'll look at the sentiment data and then revisit some of the price charts, some of the breadth charts some of the key ratios that tell you about leadership and laggardship to try to make sense of things. And a couple charts that caught my interest today. This is my chart of the VIX. I really liked the way that Frank showed it earlier, Frank Cappelleri, looking at the big moves in the VIX. It's that thinking about it in terms of the rate of change. It was really interesting one. That was a thought-provoking way of approaching this. I'm, from a super simple way, I'm looking at 2022 as a particular volatility regime. That's kind of how I describe something like the VIX. This would be every 6 to 12 months, you kind of have a shakeup. You have a change of character of the chart, which usually reflects a change of character in the market. And I'll show you, I think we've had maybe 3 different changes here pretty significantly over the last 3 years. In 2020, of course, we had the COVID sell-off February, March of 2020. You saw the VIX spike to extreme levels, getting above 80. And that seemed like an unreachable level. Never imagined you would see the VIX spike up that quickly to that level, but it certainly happened. From there, the rest of 2020, I guess maybe the second regime would be sort of a period of elevated volatility where the VIX fluctuated between 20 and 40. 2021, when we got into the second quarter, look how the entire range of the VIX becomes compressed and becomes much lower. This is as we sort of, resolved that the world was still going to survive and the COVID era was going to continue, but we're not wiping off our grapes anymore before we eat them. We're actually settling more into what this new life is going to be for all of us in the COVID era. Then 2022, of course, pivoting from a bull market phase to a bear market phase, dramatic change in Fed policy, dramatic change in liquidity, and certainly dramatic impact on risk assets. Bullish in 2021, very much bearish through the course of 2022. But look out the entire range of volatility, quarter sort of pushes to the upside, now ranging between 20 on the lower end, 30 to 35 on the upper end. Now, again, what's fascinating is if you look at the charts of 2022, one of the great exercises I try to do at the end of the year is look back and think what indicators, what tools really captured the turns in the year. And those are the things that I will start to think about going forward, right? Is there anything missing from my tool? Is there anything I didn't prioritize it? If I had prioritized them maybe higher in my process, it would have given me a much better indication of turns. And the VIX, as I go through this process in a couple of weeks, I wouldn't be surprised if the VIX gets bumped up in priority in my own head. I looked at the VIX very little in 2021, a little bit, but things were sort of slow and steady. Everyone's a genius in a bull market. Volatility doesn't matter because the market just continues higher. In 2022, it's a choppy market. There are a lot of changes in leadership, a lot of different narratives, a series of very impressive bear market rallies. And the VIX getting down to 20 has been a fantastic indicator of the end of those phases, which is why, as I've mentioned many times recently, I think we're at a pivotal time here. I think this could be the change. This could be the beginning of a new reality, a new volatility regime going into the new year. And I don't know what that range is going to be, but it could be different. One of the ways it might be different is if we would have a sustained rally, the S&P above 4,100, the VIX remaining low. Now that is what I would be looking for. We have not seen that yet, to be clear. We've now seen a bounce off of 20, all of a sudden looking very, very similar to what we saw in August, and in some ways very similar to what we saw in late March. So the VIX for 2022, I think has been a key chart. Going through the beginning of next year, I think could be important as well. The second one here, as we talk about sentiment, is the AAII survey. Now, this is a weekly survey of individual investors. You're asked, are you bullish, bearish, or neutral on stocks? And you get a group of respondents. And one of the great values of this particular survey is that it's been running for so long, for decades. You can go back through previous bull and bear market cycles and see what happened through these measures of sentiment. Similar to how you saw the difference in the VIX in 2021 versus 2022, you can also see a marked difference in the sentiment readings, right? Look at where the bullish sentiment readings can get when the market is in an uptrend, right? Starting in November of 2020, we almost got to 60% bulls, which is an incredibly high value for this indicator. About 50% is actually pretty strong. In a downtrend, in a bear market phase, you get the bearish reading getting all the way down to 60%. If you go back, these are some of the lowest readings in the history of the indicator. Very rare that you get investors that negative about stocks. Last couple times that we've gotten an indicator that low, by the way, are in June, which was when we bounced off of the 150-week moving average for the S&P, and also at the late September, just before the October low. So where are we at now? What's interesting in the last couple of weeks, you've actually seen the level of bullishness come in. You've seen the level of bearishness actually remain fairly steady. So around 25% bulls, around 40% bears. That's a spread of about 15%. And that is pretty much average. I mean, maybe in the middle of the range that we've seen, sort of a median value for 2022. So we're not seeing a huge influx of optimism. I'm actually seeing skepticism on this survey, and a lot of people still a little nervous about what may come next. That's also reflected on this next chart, which is the name exposure index. This is a weekly, actually, I think it's actually more common. It might be a more frequent survey of active investment managers, so money managers. And what percent are you allocated to the equity markets at any given point? It's currently around 56%. The average reading, if you go back through bull and bear cycles, is around 70 to 80%. So what's interesting is even as we've had this rally off of the lows, you're not seeing money managers in this survey get net bullish, right? So if you look back in 2020, obviously we had the COVID crash. We got down to single digits of allocation to equities, but then a couple of months later, we got above 50%, above 80%, and that was here in May and June, actually pretty early off of the lows after that V bottom. We're a couple months in off of the October lows now, right, about a month and a half, and you're not really seeing it get above average, right? So still fairly defensively positioned. The last chart, then I have to move on and wrap this show, is looking at the put-call ratios. A really interesting development in the put-call ratios. I'll spend a minute just talking about this. The put-call ratio is usually thought of as a contrarian signal. The idea is when the market sells off, investors will get very defensive. That means we're much more often betting on puts than on calls. Basically, in general, a bet the market's going to go down versus going up. As a result, when the put-call ratio spikes, it's usually a contrarian buy signal, meaning investors are so bearish, you probably expect a contrarian move to the upside. You can see that happened here in June. In late March and mid-August, you had the opposite, right? The market rallying, investors getting pretty optimistic. Calls are way more outweighing puts. As a result, the ratio gets very low. So it's a contrarian sell signal. What I just explained to you, which is how I was taught to use the put-call ratio, has gotten completely exploded in the last 6 to 8 weeks. Coming off of the October low, you're getting these crazy spikes in the put-call ratios, reaching some of the highest levels in the history of the indicator. And I'm presenting this to you as more of an open question. I'm not 100% sure what to make of this. The fact that the market is rallying, but in the options market, you're not getting investors getting very bullishly positioned. They're still very, very cautious. And all I can say, my immediate takeaway is that investors are still super skeptical and are more thinking caution going into to the new year. I don't know how good that makes me feel. I don't think I could consider that contrarian buy signal. I think that's a question mark. We'll have to see how this plays out going forward. It might be a really important chart to watch. We need to wrap the show. Let's go to the 3 and 3. It's going to be more like the 3 and 1 today, but we are going to do it. And let's get to the 3 charts that tell the story of this market. Chart number 1 is NVDA. We were talking earlier about the move higher today in technology, by far outpacing the other 10 S&P sectors. When I'm looking at the chart of NVIDIA, it stands out as one of those sort of bullish outliers. Really nice move off of the October lows. The relative strength, which had been negative since its peak in late November of last year, has really reversed to the upside. And coming out of the October low, NVIDIA has actually been a leading stock on a relative basis. But if you look, we are now approaching the 200-day moving average. We're not quite to a 38.2% retracement, which is just below $200 a share, but that's very close to the peak we had in early June, very close to the peak we had in August. That also lines up with a trend line from the 2021 to 2022 highs. I'm impressed by the rally in NVIDIA. I'm concerned at the amount of overhead resistance. This has been our concern with the S&P, and I think on an individual name like the NVIDIA, I'm seeing that same cause for potential concern. Chart number 2, in my segment on sentiment, we talked about the put-call ratios. Again, I'm not quite sure what to make of these extreme movements in the put-call ratio. I'm going to dig in and talk to some of my friends in the options industry to see what they think. If any of you have suggestions or ideas about what to make of this big spike in the put-call ratio, let me know. But usually when the market has rallied like this, you'd see the put-call ratio actually spike downwards, not upwards. Finally, let's finish the show with the chart breaking out to the upside. I thought Frank's chart of Regeneron was a really good example in the healthcare sector. I'll highlight PDD, which is Pinduoduo. It's a Chinese name with a nice break above $70 a share that gets us out of a basing pattern and making a new multi-month relative high. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close. Special thank you to Frank Cappelleri from CappThesis, sharing his thoughts as well. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.